Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. US data has started to weaken and markets are questioning the Fed. Will the Fed continue to raise rates even if it means a recession? The coming months will tell us. And on the R word, we published a new piece on 4 reasons for a US recession in 2023. We're also continuing our research on crypto. This week, we look at how low Bitcoin could go before it becomes cheap. And we also look at how safe is the stablecoin Tether. Then on equities, we give our take on the US sector we'd like to underweight. And I have an announcement to make. Due to endless requests, we have launched a new free newsletter to give more and more people access to MacroHive. The newsletter will contain charts, explainers, and unlocked content from our Prime product. It will be a weekly dose of sanity in an uncertain world. All you need to do is go to macrohive.com/free. That's macrohive.com/free and just enter your email to get the letter once a week. And now on to this episode's guest, Stéphane Ouellette. Stéphane is CEO and co-founder of FRNT Financial, an investment bank focusing on crypto and digital assets. Before founding FRNT, Stéphane ran various teams at BMO Capital Markets. And I have to say that Stéphane is one of the few voices in the crypto industry who sees the negative as well as the positive in this new asset class. So now onto the podcast. So Stéphane, it's great to have you here. It's great to have you in person as well. Now that the lockdown restrictions being lifted, we can start to have the podcast in person. So welcome to our offices.
Thank you very much. Very happy to be here. Great. Thank you for inviting me.
And also, just for the benefit of our listeners and viewers, there is a thunderstorm going on in the background. So people do hear thunder. It's the weather. And
those are some of the biggest hail rocks I've seen in a while. I don't know if you noticed those. They were enormous.
I did. Yeah. But Stéphane, let's kick off with a question I always ask all of my guests. Essentially, what's your origin story? Mm-hmm. You know, what did you study at university? Yeah. Was it inevitable you'd end up in finance mm-hmm. and then later, crypto? And how did you end up where you are today?
Thanks. I like that question. It's something that I've thought a lot about. My origin story in markets definitely predates university for sure. When my dad was a stockbroker by trade who ended up getting into management and ended up architecting some wealth management companies in Canada. And when I was very young, we had this routine where I'd come in the floor in the bedroom in the morning, and he noticed that I was looking at the sports scores and circling who I thought would be the winner the next day. This was like 8 or 9, and then he was a huge stock market player. I mean, he ended up becoming more of kind of a manager at like bank-like firms, but his real passion was the market, and so he kind of casually slipped a stock page in front of me when he saw me doing that, because I wouldn't even watch the games. It was really just kind of like the prediction and statistical that I was interested in. I wouldn't even watch them. I'd just come in the next morning and be curious to see who won.
How old were you when you were doing that?
I was probably 8 to 10, something like that.
Okay.
And so he kind of started slipping the stock page in front of me and saying, well, which ones do you think are going to be up tomorrow? Which ones do you think are going to be down? And then that was like crazy, because it went from having 10 games to having thousands of stocks. So I was very interested in markets from when I was very young. As I kind of got older, the elements of markets where you're really playing for keeps, you're really held heavily accountable to your you can't just say something and then assume you're true and walk away. It's there's a lot of accountability to your analysis, and just the concept of just being able to really read the front page of the newspaper and see how that applied to what you were doing that day always really appealed to me. That the front page of the newspaper was kind of your world. So throughout high school I started trading a little bit of stocks on my own, went into university and really kind of picked up the mantle there and got really excited about the market. It was really everything that I was doing all day, skipping class and watching the market and stuff like that. And I had an opportunity to work on a trading floor in the summer, just kind of in filing documents and stuff like that. So I worked at the BMO equity floor in Toronto. Got down there and just kind of fell in love with it, on a whole other level. It was really kind of the end of the kind of prior generation of traders, really old school type characters that where the days there were just wildly exciting, and it was just couldn't get enough of it. Just would spend all be on the desk till really late at night. and then, felt like I was a large company and I was probably moving a little fast for the way that my managers felt, and was really feeling like I had more energy to expend on just some ideas. And so I connected with a gentleman called Adam Rabi, who's a co-founder of FRNT with myself, and we built other businesses together as well. And it was very clear that we had a complementary skill set. He came from entrepreneurship and he was a software developer. I came from the corporate world and was more on the sales side. So we initially started talking about launching a new kind of HFT style macro fund together in 2016. Adam was an extremely early participant in the Bitcoin ecosystem. He has a 10-year-old dog called Satoshi Nakamoto, which my head of investor relations has heard me say a million times at this point. But really passionate about the space. And in 2017, as we were kind of sitting down talking about building another hedge fund, the liquidity in the market exploded, and in our opinion, that was a real turning point for the industry from the way that we looked at it, because it went from being something that was much more venture capital driven to something that you could actually trade with algorithms.
What year was that?
2017.
2017.
So it was things like not only the liquidity that came in, but you started to see a lot kind of more consistent infrastructure emerge in the space. There was, and it's a constant issue, banking issues in the space, but there were things like futures platforms like BitMEX had really started to pick up its liquidity, and that was a really consistent platform. So there was a lot more moves that you had to trade, and we could not believe the market inefficiencies that were in the space, and honestly still are to this day, that were driven by things we could understand very easily: high levels of retail participation, a lack of infrastructure, lack of understanding in the market, and consensus around valuation. So it was all the things that had created inefficiencies historically, and we're kind of fully on display in this space. For arbitrage, trades 24/7, and data's free. So there was so many benefits to new entrants. So we launched a prop vehicle, which has since become a hedge fund, together, and built FRNT to be an institutional service provider that started off as a trading firm to educate institutions and provide synthetic exposure for some of these dynamics that we had become well aware of in this other vehicle that we were trading. And since then, FRNT has grown into what we're referred to as a challenger investment bank, emerging out of crypto. We have deliverable service lines where we trade where we assist clients in trading physical crypto, lending it. We have derivatives. We have an asset management arm, which tries to work with larger investors to help them set up their own portfolios. And we have advising, consulting business lines that now are looking very much investment banking like. So that's the full origin
story. That's a great story. Yeah, I didn't realize you were so into trading and stats and all of that type of stuff at such a young age.
Yeah, it was. It's just something that's all. It's just I got lucky. The fact that it was something that I really stuck to. That really appealed to me from an early age, and it kind of became my thing in school.
Yeah.
So and that was. I developed an identity around being someone who was interested in the market, and I think my friends thought it was pretty weird until then they were looking for jobs out of school, and I was like, okay, I guess we're all going to be doing this now. So, yeah.
And now onto the subject of crypto. I mean, one question I often get asked, because we've started to cover crypto for about a year now, and we still keep coming back to this question from people: what is the use case of crypto? So, how do you go about answering that question?
Yeah, I mean, I think that it's a question that's kind of taken on a life of its own in the space, which I think isn't exactly logical. I mean, I think it's quite clear what the use case for the most popular use case for cryptocurrency has been. It's been as an alternative. It's essentially been used as an alternative currency, alternative investment. So people are either buying, getting into Bitcoin to spend it eventually, or they're viewing it as a potential alternative currency that will continue to grow and will become the infrastructure around payments will grow, et cetera, et cetera. I mean, I think that's really been the ultimate use case of the space that's had staying power, and it's been around for a long time. and that kind of investment versus that speculative versus kind of use case as a currency kind of the has ebbed and flowed in really aggressive bull markets. A large percentage of the market is speculators, and in down markets, a lot of people who are still kind of purchasing Bitcoin are using it as a serious allocation in their treasuries, or they're using it for payments, or they live in countries where the Bitcoin ecosystem is a lot better than what they have and all that. But that is a very inconvenient story for the majority of the world who has developed on the back of fiat systems. Yeah. So I find that narrative is being fought constantly. And in the prior cycle, you had, one of the things that people said was blockchain, not Bitcoin. And that struck me as bizarre because, well, there's really been one successful use case of blockchain technology historically on a global level, and it's been Bitcoin. So why would you say that the thing that has worked is not the thing, and the thing that hasn't happened at all yet is the thing? I think it's like a psychological, it's a psychological reaction to a very inconvenient development for the largest industry in the world, which is finance. So
yeah. And then within crypto, obviously there's different areas. So one is smart contracts and DeFi, mm-hmm. that kind of whole arena. Obviously Ethereum, the dominant smart contract or L1 platform. So what's your thoughts on Ethereum, and then also its challengers, the Solanos, the Cardanos, and Avalanche, and so on?
I've consistently said that the market has very much underpriced the risk in Ethereum, and I think that Ethereum is something that's kind of defied logic for a very long time. A lot of the things that Ethereum, still a proof of work chain. A lot of what Ethereum has focused its development around are applications that you could build also in the Bitcoin ecosystem. But Ethereum has really did a great job with the marketing element around them being a smart contract platform. Mm-hmm. So for a large part of Ethereum's life, there has been this perception that it can do things that other blockchains cannot do, which I think is much more of a marketing move, and then that leads to now more focus on development there. So it went from being a kind of a marketing play to now there's a lot more decentralized applications on Ethereum. They also have ERC20 tokens, which allow for additional economic incentives that allow people to launch their own tokens, get huge valuations themselves, and do really well. So there's that maybe started off as a bit of a myth, but has really grown into it being true for a variety of different reasons.
So you'd say that you could do the same things with Bitcoin?
I mean, there's a lot of there's layer technology that is decentralized on top of Bitcoin, like the Lightning Network and stuff like that. There's platforms like RSK, which is a smart contract platform. I think there's a lot. It doesn't have the same kind of incentives embedded where I can launch my own token and then I can do a pre-mine and get really wealthy. So people kind of look at those projects as I mean, I feel like the rest of the ecosystem looks at a lot of the developments going on in Bitcoin and saying, like, what are you guys doing? You guys are basically doing this for free. So a lot of these companies have extremely limited valuations, relative to what you typically see in the token ecosystem. And I find it to be a different attitude the building that occurs in Bitcoin. But now I think that the risks of Ethereum, as you allude to, are extremely elevated. And it's hard to see how this is all going to play out, but at least these are all on the table. The transition from ETH from a proof of stake consensus algorithm to proof of work consensus algorithm, proof of stake consensus algorithm is one of the most complex transitions that we've probably ever seen occur. Okay, Ethereum has managed to rally its community in a lot of impressive ways, but they've also had much less complicated developments that have ended in kind of 11th hour panic situations, like the Constantinople upgrade 2 or 3 years ago, where there's a vulnerability found at the last second. I mean, the likelihood that something like that happens in Ethereum, and obviously there's other episodes that are even more famous that you could point to, is elevated in this situation.
And we're seeing it with all the delays. It seems like it's a moving deadline. Like when the switch is going to happen.
In 2018, there were people that thought that this was a development that was a year away, right? So that's very complicated. Now that Ethereum so of course, to deal with the scaling issues that haven't been resolved by this transition to ETH 2.0, there's been a lot of infrastructure built around dealing like temporarily with scaling issues with layer technology. And I feel, those are becoming large platforms themselves, and they carry a lot of weight in the Ethereum ecosystem. And it just seems like, and so what happens if the chain goes to proof of stake? What happens to those applications? I think that there'd be a lot of concern for those entrepreneurs that their use case starts to lose value. They have a lot of weight. It seems like the whole community is moving towards, I don't know if it's going to be a hard fork, but like some fracturing if this transition to proof of stake occurs. And so it's like, okay, well, why doesn't it just stay proof of work then and focus on building layer technologies? And I don't really know why the community is rejecting that as a solution, why the major players like Vitalik are rejecting that as a solution. My feeling is that they then feel like it looks too much like Bitcoin. And that's probably, and that is problematic for them. But, as a result, as you alluded to, I mean, there's certain chains that exist today that essentially are already ETH 2.0. And so they're in a very tough spot. I mean, but the market just never seems to care. It's, they've really, Ethereum and Ether are part of the zeitgeist, of crypto now. They're viewed as, even regulators will tell you, well, okay, Bitcoin and Ethereum I know are, going to stick around, but what about everything else? So it's somehow attached itself to, the Bitcoin developments, which I think could have gone either way from a regulatory perspective in particular, but seems to have won. But yeah, I mean, it's.
And what do you make of the other rival coins? Solana, Cardano, Avalanche, some of these other ones.
I have a general skepticism around proof of stake.
Okay.
The philosophies in proof of stake. I mean, I don't think we need to get too far into it, but the criticism of Bitcoin has been that it's a Ponzi scheme, right? Because it's created out of thin air. Well, that's not really accurate on a proof of stake in a proof of work chain, because there's like large input costs in the way that there is to mining, and it isn't really just that kind of merry-go-round that it's perceived to be. Proof of stake is, it really is, and there's all of the typical criticisms that people bring to things, Ponzi's, helicopter money type things, and like fiat systems in the first place, right? I think you apply the same criticisms you bring proof of stake, and there's other kind of governance elements around it that make it sound less democratic with the staking process, etc. So I have a hard time getting fully on board with proof of stake. I think that these other chains, have done a very good job in developing themselves and growing. But it's so early, right? It's just it's hard. If these were just technology that was, if Solana, for example, was had a valuation in the kind of billion to $1 to $3 billion range, say, I would say, wow, that's like that's expensively valued startup, but there's a lot of smart people behind it, and they're really committed to this. So okay, but that's not what you're getting. You're getting like $50 billion Solana. You're getting it was essentially ICO'd in the beginning of 2021, and by the end of the year, it went from a $75 million valuation to a $75 billion valuation. And so it's always like, you want to be you want to be positive on some of these developments, but I mean, like it's hard to be positive when you look around and you're like, okay, I think there's enough positivity out there for this thing. It's got a $75 billion valuation, right? So I tend to find myself being more of a detractor, but not because because I'm all that negative, but I just to kind of counteract what the narratives that are out there, and people that are way too excited, that haven't done any homework, that lean on very flaky analysis to suggest why, or no analysis at all, right? Just like a friend told them or something like that, and you're a naysayer if you say anything else. So it's I find that that while there's interesting developments, a lot of these protocols are in their first year of being operational. Some that have very large valuations haven't even launched yet, And so it's interesting early technology with an uncertain use case that I think we're going to get into a bit, that has kicked off a whole bunch of different things that that I think that there's a lot more that's going to evaporate than will stick around in 20 years time.
And one of those use cases is decentralized finance, or DeFi. I mean, how do you think about that? I mean, that seems to be a potential, like a clear use case, as in it's challenging traditional finance, it's creating new mechanisms for people to borrow, to lend, obviously new forms of speculation as well, or different version of speculation. What's your thoughts on that space? And obviously there's lots of accusations that it's a Ponzi scheme as well.
Well, yeah, I mean, I just don't think, I think that there hasn't been I haven't been clearly showed that there is real demand for decentralized trading applications, as opposed to there being, as opposed to the reason why the space has grown so much is due to dynamics like yield farming, which I think are artificial, and I can talk about that, and regulatory arbitrage. So I mean, those are the two mechanisms that I have seen grow the DeFi ecosystem, and I haven't really, outside of this like little narrative that happened in the summer of 2021, where people were, accusing Robinhood of favoring Wall Street pros versus the retail investor, I have never really seen a use case where decentralized trading application for someone who has, launched hedge funds and, investment banks. I haven't really seen a use case for decentralized trading applications that I would want to use myself. I'll give you an example. I mean, these decentralized trading platforms have been around for a long time. I mean, Bitfinex had several in was launching several in 2017. They launched Etfinex, they launched EOSfinex, as their names would suggest. They were on different blockchains, and they were trying them out. And myself and our team would observe them, in the couple millions that had traded a day, as kind of an interesting, very far off future development for trading. But we would never want to trade on them ourselves because, one, if something goes wrong, if they're really decentralized, there's really supposed to be no one to call. And even if you could get in touch with somebody, they can't fix it anyways if it's really decentralized. So it seems so irresponsible for us to trade using this early technology on platforms that weren't really offering anything else to us besides, like, they weren't offering anything else. They were the exact same as, like, in those cases, they literally looked like the same order, like they looked like the same order books too and everything. But to take all that risk, what we're really getting back. Yeah. Like I can't even, I don't know what we would be getting back. Some kind of self-custody element that I'm also skeptical of. But in 2020, the entire DeFi ecosystem took off for the first time ever. And why did that really happen? The first thing that happened was Compound Finance launched a comp token, where you were able to post at much more mature assets like Stablecoin and Bitcoin and receive a yield in comp token, right? And that's how almost all these yield platforms are. You get in kind, you're paid in kind, right, with their token. Well, that was, this comp team is like, the comp team, from what I can see is, they seem like honest operators that want to build technology and all that. I think that they just had really, I don't want to call it excellent, but the timing was such that there was, people like Paul Tudor Jones had just started talking about Bitcoin, and it was already kicking off this crypto rally. So something like compound finance and comp token sounded new, and people got really excited about this token as well. So it almost instantly overnight traded to over, to a huge valuation. I believe over $1 billion, overnight. Okay, but this is a platform that has very few earnings attached to any kind of token, uncertain governments. From my eyes, it's an unregistered securities offering. So why on earth would it be trading above $1 billion valuation like the next day, right? So that was an inflated token valuation, I'd argue, that was now allowing them to pay their counterparties in outsized yields, because there is a yield on Bitcoin. You can go to peer-to-peer lending markets throughout the entire crypto ecosystem, and you can see what the yields are on Bitcoin. That right now they're particularly low. The market isn't in an aggressive bear market where Bitcoin yields would typically increase because people borrow it to go short. So there's no magic to the yields. Like they're until you get this token dynamic in there. And so after that happened, there are tons of copycat platforms that came out, and a new use case for for decentralized trading came about, which was platforms like Uniswap, which allowed a venue to launch these new tokens, which is an unregistered securities offering, which very much looks like an unregistered securities offering, right? So now Uniswap's growth, you can go, well, why do people use Uniswap? You know, that's not a yield farming platform necessarily. And it's like, well, they were using Uniswap to launch more yield farming tokens, right? So, you know, like
And the yield farming, all of that works as long as the newly issued token is going up in price.
Yeah, or is at a level where the company feels comfortable with dilution in paying outsized yields, right? But it's all predicated on the value of this token, you know, maintaining its value. And if not, you know, if you talk to most people who do yield farming, what they tell you is that they earn token and they sell right away. I mean, but not everybody can be doing that, right? Like, or else these token valuations would never get off the ground, right? So, needless to say, there's setting up. So if you pledge an asset like Bitcoin and you receive comp token, and the market starts to turn, I mean, your entry was very easy, but your exit is a very small window, right? Because those tokens will have a lot less liquidity, you know, a lot, and it's like essentially like a carry trade that's going to be tough, that could have a huge unwind. We've already seen this occur at this point. I mean, this is dynamic we've been talking about throughout all of 2021 at our firm, and you know, it's one of those things where you look like a dummy 99% of the time until the one day that you're right, you know, and you miss out on huge gains and all this kind of stuff along the way. But
and on the interest rate side, so you pledge, you receive an interest rate, and then on the other side, who's borrowing and what they're doing with the borrowing.
So I mean, on the other side, I think a lot of these things are complete black boxes, right? So you really don't know what's going on, and I mean, black boxes to the extent that sometimes these platforms have launched and the next day they've run away with the money, which is now has a name to it that's well known, called a rug pull. But I mean, they could be doing anything, right? Like if you pledge US dollars, like through a stablecoin, the firm could turn around and actually lend that US dollar stablecoin out in peer-to-peer lending markets, which during the bull market last year, at times, because you borrow US dollars in the crypto ecosystem or stablecoin to go long, right? So in a market where everything is going up, US dollars and US dollar stablecoins have outsized yields. They have for a long time, which is a great arb trade that we try to speak to institutional clients about. But again, you know, they're very you don't have as much success with that as you might think. But yeah, like you could get 18% yields annualized on US dollars or Tether often last year, 18, 20, 25%. So the company doesn't pay you yield in Tether, they'll pay you yield in the token they receive, and they go out and they get the 18% annualized yield for themselves, right? Yeah. So but again, like there could be many things happening behind the scenes, even a lot of centralized platforms, lending platforms, not a lot, but there was a couple large blowups in centralized platforms throughout the worst parts of the pandemic. Because what was made evident when there was one in particular was that what they were doing was actually, you know, hedging. You know, you lend them Bitcoin, they hedge your Bitcoin exposure, and then they take fiat and they lend it to high-risk borrowers at much higher levels. So it didn't even have anything to do with crypto. They were kind of just using it as a layer of obfuscation on top of like some other high-risk lending that they were doing, and they blew up. So there's very little understanding of how these.
And you were saying these new tokens, they're in effect like unregistered security offerings. So that implies that there's a clear regulatory arbitrage that.
I mean, we've already seen this occur in ICOs, right? Like this is like, you know, and the whole industry was referred to as an unregistered securities offering, and there's still people in court right now suing the founders of these platforms because, you know, they lost all this money and now they feel like they can claw some back because it was an unregistered securities offering from the start. Some people, you know, some of the larger platforms had people that got into a lot of trouble because of this. I mean,
and just why are the new tokens issued today not called an ICO? I mean, what's the difference between an ICO and what's happening?
Like new branding.
It's just branding.
It's the whole NFT craze was also first seen in 2017 by actually a lot of similar developers that sponsored the NFT craze, like CryptoKitties. CryptoKitties, I hope I don't get this wrong, I believe was launched by Dapper Labs, they're a Canadian company in Vancouver. Yeah. And you know, we saw this happen before. There was CryptoKitties that were trading for $350,000, and then, you know, some sold at a penny a couple of years later, right? It's so It's so there have been, there's been, I don't think there was, in this last wave, there was all that was completely new. I mean, a lot of this stuff has been tried before within the crypto ecosystem, and had a lot more success this time. People's imagination ran a lot. I'm not exactly sure why the crypto ecosystem was more creative this time when seeing the concept of NFTs than they were when seeing CryptoKitties, because essentially, they're very similar things. But everyone's brain kind of ran wild with this. There's a lot of industries that are looking for some kind of tokenization, like the art industry is dying for some kind of digitization because they feel like they've been left in an analog world. And if you talk to people about NFTs, a lot of time they want to talk about derivatives on art and shorting it and all that kind of stuff. So there's a lot of people that are waiting for this. But yeah, a lot of what we saw in the last this last round, it's like a very similar playbook to what happened in 2017, 2018, and before that. I mean, 2013 was a little bit more of an issue. Was a little bit different issue because it was really kicked off by the MT Gox collapse.
Oh, yeah.
These last two, I'm sure that the mainstream media will ascribe why the market sold off, but really it was just an overheated market that turned. You had things like interest rate dynamics changing, and why is the market selling off? Why did Dogecoin have a $50 billion valuation, right? Like that's not the question people ask. People go, why is Dogecoin selling off? You'd be like, I was more confused. I was up here in the first place. With so little developer activity on the blockchain.
And you mentioned NFTs, and then more generally on Metaverse. I mean, people use the term Metaverse, and I mean, what's your sense? I mean, from what I can tell, Metaverse means either, there's virtual land, and then there's the gaming side, kind of the two main types of coins, as far as I can tell. But how do you see the Metaverse in crypto?
It's funny dynamic too, because like the concept of Metaverse, of human future in a metaverse. I mean, I have a classmate who was writing on this dynamic as early, in 2020, and he was writing, Matt Ball, if you're listening, I'm talking about you. But he was writing really well thought out articles about the metaverse in 2020, and what he was talking about Fortnite, and how Fortnite had essentially, the Epic Games property, and how Fortnite had essentially created the most, visible network, metaverse that we had seen, at least the most kind of 3D kind of representation of what we would think something like that would look like. And also the CEO of Epic was very vocal in saying he was building a metaverse company, right? But that got very little attention. And I, was very interested by that concept. So I was, following it very closely. I mean, I was thinking that this was something that was going to be a 50-year development, and very quickly with the pandemic, it became something that extremely large companies were betting on happening a lot faster than that. And now there's multiple companies that refer to themselves as metaverse companies. Like I haven't actually seen a Microsoft executive do this, but Epic refers to Microsoft as a metaverse company, right? Not to mention now a company's called Meta, right? So it's all played out a lot more quickly than I think any of us really expected. But that said, we're in this space with this dynamic where it's just it's chaos in terms of people's understanding. I mean, people call whatever we're experiencing right now the metaverse, right? In the same way that people said the blockchain, right? As there is no the blockchain, there are blockchains. There are competing blockchains. There are blockchains with X use case, X focus, whatever. There are competing platforms that want to be the dominant metaverse going forward, right? Like that's what's happening. There isn't the metaverse. There are competing platforms that want to basically win the metaverse race, and it's like extremely uncertain what that's going to look like, right? Like because probably the most visual representation of what a metaverse could look like. Okay, maybe you could argue it's something like Fortnite, right? Yeah. Or The Sims or something like that. Or Grand Theft Auto, honestly, like Grand Theft Auto's multiplayer mode. But the firm that obviously looks like they have the easiest jump to like some online avatar is Meta, right? Meta, Facebook. So whatever, it's really, really early days of these dynamics. Whether or not these companies continue to invest as much as they have been in this evolution, I think it's going to be a hard sell, especially with the markets that we have today. I mean, these pie in the sky ideas of changing the world aren't really what companies focus on when their stock prices are down 50-60%, right?
Yeah.
So I think you could get a really big break in this evolution. That said, this is obviously where the world's going. I mean, I'm really avid follower of esports and gaming and Twitch and all of that, and I think that even the millennial generation, not just the Gen Zers, like the millennial generation, is completely unaware of what's going on these platforms. I think that there's going to be this huge shock when the current 12 to call it 18-year-old demographic of today has spending power in their late 20s and early 30s, and what they spend that money on, what entertainment they spend that money on, I think is going to shock everybody. Like, I mean, it's like the celebrities, I was saying to someone else the other day, I couldn't even tell you who the CEO of Warner Brothers is, but I'm wondering if they know, people like Tfue and Nick Merckx and and Pokimane and all these people that are massive online stars. XQC is a Quebecer from Canada, who was a former Overwatch pro, ended up getting basically kicked out of the Overwatch League, and just started streaming on Twitch every day. He streams for 10 hours to 100,000 viewers.
Wow.
Like, I mean, I can't even think of any other people that could do that. And this is the world that that generation lives in. So we could say, I don't really feel comfortable with this concept of metaverse evolving. I like life the way it is, with this kind of 50-50 digital life. But you got a generation coming along that is very comfortable with this metaverse.
Yeah, absolutely. I mean, just
concept.
one kind of anecdote in that regard would be, my son's 14 right now, and during the pandemic, obviously there was lockdown, so he wasn't able to meet his friends. So what they did was they met on Fortnite, and they didn't engage in the game.
I did too.
And they just met some corner of the island and fooled around and played games and stuff with each other, and that's how they interacted with each other every day. And that was so natural for him. They said, "Oh yeah, we're just meeting Fortnite," and it was like no.
Yeah, I mean, it gets even crazier than that, right? And these these large online multiplayer games, there's people who have jobs in these universes, that they actually have a job that they go to. They're exaggerating a little bit, but they're like a cashier in Grand Theft Auto, right? It's for those that aren't familiar, jumping into that world would look crazy. Yeah. So this is already happening. This has been a trend that has been developing for a long time. I mean, it was funny, watching a lot of Twitch during the pandemic. You'd hear these gamers that would basically say something along the lines of I wouldn't even be able to tell you it was a pandemic right now. I've been living like this my whole life, right? And it's true. And those kids, they strap in every day online. And it's not they're not quite an online avatar yet, but it can't be that far away. Every day these people put their headphones on, they stare at screens for 10 to 15 hours a day, and they are in the game. That's their kind of, they know the whatever map they're playing much better than they know their own neighborhood, Yeah. So these trends.
But what do you think? Do the crypto versions of these bring anything new to the table? Because when you look at Fortnite or Grand Theft Auto, it's amazing graphics and amazing gameplay. But then you look at say Axie or just some of these other crypto type games, which are more, I guess, about the economics perhaps. But do they bring anything new to the table?
I don't want to talk about individual platforms. I'm not rushing out to play any of those games, and I like playing video games and stuff like that. I think that the crypto doesn't really want to talk about that because the most successful kind of online currencies outside of things like Bitcoin, etc., have been things like in Fortnite they have V-Bucks, but there's no element of decentralization to V-Bucks. It's literally just it's instead of getting currency from your government, exchanging it with another government's currency, you're getting Fortnite's currency, and there could be a lot that they do with that and create an economy and all that kind of stuff. And on another time we can talk about how that's kind of what Libra should have done. But it's these the game's user bases are really young, right? So that's kind of what the issue that everyone's running into here. It's first of all, I was speaking to somebody the other day that they had a kid that wanted to play one of these centralized games, and they asked for money to be sent to them, and it was like an enormous amount of money that they would need to participate in this game. And that's it's a big enough problem when kids want their parents to give them $10 to buy the latest skin for their character online. So yeah, I mean I don't understand. I'm not as familiar with it, but I don't really understand it's not an area of the ecosystem that I've spent a ton of time focusing on. Maybe I've written it off a little bit too much because of the dynamics that you're saying. I just look at the games and I go, I don't want to play this. So maybe I haven't, done enough homework on kind of what this could be. But again, as you can tell, I'm kind of skeptical about those pie in the sky ideas anyways. And it's like, if it's a great game, you'll do fine. And you don't really need to worry about this crypto component. And if you wanted to, you could inject some kind of payment in there with, like there was this huge scandal that came out of Counter-Strike where kids were using skins that would go up in value because you could trade skins, and they were betting with skins that they bought, right? On and some of these skins are like $10,000, right? So like, I mean, it's, for the unfamiliar, it's like pretty crazy world out there with the video game economics. But in fact, a lot of these platforms have, because they didn't want to end up in a scandal like that, you just buy skins and that's it. You can't sell them anymore. There's no mechanism for selling them. Or if you believe that you've sold your account to somebody, which used to be like a retirement plan for like a Counter-Strike professional, you'll get banned. The account will just get deleted. So they've actually moved away from that to avoid the issues that it seems like some of these crypto-based blockchain games are like diving headfirst into, right? And these guys are really the experts. So,
And then how about stablecoins? Obviously, we've had the whole Terra Luna blow up.
Yeah.
What's your take on the whole sort of stablecoin landscape right now?
Yeah, I mean, I think probably the easier way to talk about how much different like the Terra Luna dynamic was from typical stablecoins, because that week basically what happened was Luna completely blew up, and then the next thing was is Tether going to blow up, right? And so the Luna blowing up dynamic I think is clear, and the Tether not blowing up dynamic I think is also clear. And I would love to sit down with some of these investors who I have respect for, who really put a significant amount of money into Luna, because like I don't understand what they were thinking. And it's not that I don't think that they're smart people with theses. I can't see what it would have been at the start. So I'd like to hear that and show myself wrong. But as I mentioned, myself and my co-founder founded another a business that's a hedge fund that does primarily arbitrage, right? Like that's really all we do with that vehicle. And so stablecoin arbitrage has been a semi-consistent strategy for us. You don't really get an opportunity to arb stablecoins very often, but when you do, they can be quite interesting and lucrative.
And the way you arbitrage is, say for example,
so it's easiest to start with the traditional kind of what they refer to as like centralized stablecoin like Tether, okay?
Yeah.
So with Tether, if Tether trades below par, you buy it at a discount, and as long as there isn't a major banking disruption or some kind of fraud that's occurring, which is at the stablecoin issuer, there's no kind of time sensitivity around that. If you buy Tether at 90 cents, you're bought something at 90 cents for something that someone's going to exchange to you on perpetuity at 1-to-1, right? So 1-to-1 plus, in Tether's case, 10 basis points, if you're a market maker. So you just buy it, you can go to sleep, wake up in the morning, there's no kind of time sensitivity. You just go and so that's that. As long as you don't have a counterparty risk blow up issue, that is a real arb, right?
And the risk there would be that the counterparty doesn't have the adequate collateral.
Yeah, right. So when you buy USDC or Tether or the two largest centralized stablecoins at a discount, and you go to their mechanism which allows you to redeem it. So you give them a bunch of Tether, and they need to send you a bunch of US dollars, right? And so if they don't have the US dollars sent back to you, okay, now you got a big problem.
Yeah.
But as long as they do, that's, everything's completely fine and you've got your trade. And by the time you get the money in your account, the trade's over. You're right. Like, it's not like, oh, I still don't know what's going to happen here. It's like, once you get that cycle through, you've won. The trade's done. But the issue with that and this concept of an algorithmic stablecoin, and I do think that there's ideas in the algorithmic stablecoin landscape that you could push further, but with the way that this had been architected was you need to run that process, you need a bank account. You need a bank account.
Yep.
You need a bank account. And unless you had a very small amount of market makers you plug in directly, it's hard to imagine how you could link a bank account into a smart contract, right? Which is necessary for an algorithmic stablecoin, right? It's like a smart contract base. It's like it's a crypto based dynamic that's playing out.
Yeah.
Right. And so how do you get an individual bank account into that? Okay, maybe with market maker, you might be able to find some way, but that was the struggle. So the other option that you have there is, okay, well, maybe we could buy stablecoin and put it in there. But what's the point of making a stablecoin that's full of other stablecoins, right? Why don't you just buy the original stablecoin, right? You're just adding an additional counterparty risk element in there. So this group settled on the idea that they were going to have this dynamic where if you could buy UST at a discount and then you could exchange it for a certain amount of Luna, which would be at par, and then you could sell the Luna, right?
Yeah.
The issue with that is that cycle isn't instant, right? And Luna is a highly, highly volatile asset, right? So if you are buying it at a discount, you don't actually know where you're going to sell Luna. You're taking risk as an arbitrageur who's trying to do like essentially risk-free transactions. If I buy this if I buy Tether at 99 cents, right? I know I'm going to get 1-to-1, right?
Okay.
But if I buy UST at 99 cents, first of all, they also injected a bunch of different mechanisms in there that added frictions to it because of another issue that they did, which was essentially what seems to be kind of a fractional reserve-like ecosystem. So to avoid a run on the bank, they actually created additional frictions for if there was a ton of arbitrage going on, which essentially made it impossible to arbitrage, right? And if it's impossible to arbitrage, how's it going to maintain its peg? That's who maintains the peg. Arbitrageurs do.
Yeah.
So this entity that I'm referring to, we looked at it and we thought this was going to be a great trade for us when we first started to look at these algorithmic stablecoins coming about. But then it didn't take long to say, no, this isn't this. There's no way to arbitrage this safely, right? So we had this in kind of the back pocket that this was going to be a huge problem, and we weren't sure that it wasn't going to work, but we couldn't see how it would work in particularly in a market sell-off. And so but again, then on the flip side, I guess you could short UST maybe to play that trade, but again, that was also a very confusing dynamic. I don't know, maybe UST could go up like crazy in some weird environment because we didn't understand how the ARB mechanism would work. So then you kind of all bets are off, right? So if people can't ARB it, who knows how these things are going to behave? Or go short Luna, which would have been you would have gotten completely run over by doing that because it was a very much irrational, more than longer than you can stay solvent style type dynamic. And so the thing, so that it was when the market started selling off, basically what an arbitrager would expect to happen happened. We weren't the only people that noticed that, but again, like it was very hard to do anything with it to bet against it. But then what happened was, some hedge funds, whether they were honest about they actually believe this or whether they just viewed it as an opportunity, started to say, okay, Tether's going to blow up next, and and what happened was Tether traded off its peg down as low as 90 cents, and it was a huge opportunity for arbitrageurs because that was a real dynamic. So
the important distinction here is that with Tether and dollar coin USDC, they basically have the dollars as collateral, and then you can redeem at 1-to-1
exactly
when it trades below par. Whereas with these algorithmic ones,
the way that this algorithmic stablecoin had been
this particular one,
because basically the thesis was that a basket of highly volatile assets was going to support a very, very stable peg, which already when you say that doesn't seem to sit right. But there's this kind of diffusion of responsibility around investing in crypto that's like that keeps happening again and again, because these cycles, like, it's very, I don't know of another asset class where something can go from a $50 billion market cap to zero market cap like within the span of 5 or 6 days. I mean, the people are used to seeing when the market ascribes a $50 billion market cap to something. I mean, there's been a lot of due diligence that's gone involved in this. This is like something that the market's really debated and found out, but these blow-ups keep happening again and again in crypto. I mean, like how big was Enron? Wasn't Enron about 50 billion?
Yeah.
Okay, so we had an Enron played in 6 days, and like Enron was like once considered the largest financial scandal in the history of humanity, right? So it's very strange.
And actually, on that then, so what is the current ecosystem of crypto then? In the sense that, so if I'm an institutional investor, so I'm some big asset manager who traditionally invests in like bonds and equities and real estate, private equity, that's kind of my portfolio, and I want to go into crypto, how do I have the level of confidence that this is not going to happen to me? Like what are the kind of checks and balances that would...
Yeah, I mean, what we are saying to institutional investors is more so that, we believe that, we think that a lot of institutional investors have taken this whole space off of their screen entirely. And for some of them, it's literally because the space is too small, right? Like, and so, there's a lot of reasons that people don't, people have been asking, where are the institutions? Where are the institutions?
Yeah.
Okay. Well, I mean, there's so many frictions for institutions to get into space. Like it's people, I don't think they give this enough credit. Like, if you touch crypto, your insurance premiums go through the roof. Right? Like absolutely through the roof. I mean, our company was just moved offices and we had trouble getting property insurance, which like, okay, someone has a higher likelihood of like breaking their ankle in our office than they do in some property casualty insurance than they do at like a non-crypto related office. So, there's dynamics like that. Your auditors are often adding a lot of frictions to you directly participating in the crypto ecosystem. So, we always, a core thesis that we haven't shifted around was that synthetic exposure was going to work a lot better, particularly in these early days to get institutions in. So we focused on fiat settled derivatives. But I think, the firms, even the billion-dollar hedge funds that could really trade, that are able to trade this space, a lot of them have taken it off their screen, and the reason for that is they feel it's like very trite space where everything's going to the moon, and they're sophisticated investors, so there's nothing there for them. But we think that they've completely overlooked the alpha opportunities in the space that are brought about by the market inefficiencies, and I think that is the next wave of institutional interest that's going to be in the space, because these trades are real trades that are that essentially. A lot of the so we have a whole suite of structured products that we offer that's regulated, that we offer to institutional investors that allow them to play dynamics like basis, right, and perpetual swap arbitrage. In the future we've some of those pipelines in the product, and these are dynamics that they couldn't access themselves in the same way that a lot of these investors, if they want to play an oil trade, they're not going to hold physical crude at their office or in a storage facility or whatever, right? So So I think that a lot of my old clients, because I used to cover hedge funds and all that, have literally, they may be messing around crypto on their own, but they haven't found an angle where they feel like they can put their customers' funds into it, and even owning like Bitcoin in their portfolios. I mean, these the firms that would more likely be risk forward enough to do that are not willing to hold like a passive asset, passively like an asset that volatile. It completely mess up their return profiles every month, or it would be so irrelevant that what's the point? So, but what we think that those investors haven't, are missing out on is just the massive arbitrage opportunities that continue to come out of the crypto space, that are trades that they can understand. They've played trades like this in other markets, even though they don't know it. But there's a huge mental hurdle getting these funds over the hump on, I don't trade crypto. And it's just like, and they've seen so many people come in with these harebrained ideas they've seen blow up now, And so
actually one thing I found, because I come from like a traditional finance background, is from a kind of analysis and research perspective, a lot of the so-called research in the crypto world is so immature and amateur, like
it's like full promo.
Or just full promo. It's not really research; it's marketing.
Yeah,
outlandish predictions, no no explanation of the risks involved,
Yeah.
and it's almost like fraudulent in many ways.
I
It's
think-
like quite
Yeah, I know, and so we, our firm tries to speak about the space in kind of a much more realistic way.
Yeah,
Like,
yeah.
We've dedicated our lives to this ecosystem. We're bullish on it, right? But not to be bullish on it, you don't have to, like, long-term bullish on the space. You don't have to just think that everything that's happening is going to change the world, or every implication is positive for Bitcoin, et cetera, et cetera. Like, this industry was built on people who have bought and held
Yeah.
Bitcoin extremely successfully, right? Like, that's the foundation of the industry. And some of them have the loudest voices in the space. So they're really just saying what's worked for them, right? Like,
Yeah.
buy it worked, don't worry about it. Oh, like the last time anyone was like this negative. And some of those people have taken the same playbook to things that have evolved beyond Bitcoin, like DeFi, because they're like, oh, the last time someone told me I was an idiot about investing was when I invested in Bitcoin in 2012, and look who is stupid now, right?
Yeah.
So there's so many different dynamics like that continue to push this promotional aspect. But I completely agree that is extremely distasteful to most institutional investors. This heavy promo, no due diligence, approach that people take, and you can see it in the market too, right? Like, people invest 50% of something around 50% of the DeFi assets that have been put on these platforms this year was hacked. I mean, it just goes to show how, like, no one's doing the due diligence on these things. Like, how is that possible? But there's a very low bar of due diligence for a typical crypto investor.
And in terms of the industry of sort of crypto digital assets, what do you think is the elements that are missing when you compare it to, say, the financial industry? Like for example, there are now kind of investment banks like yourself, offering the services of an investment bank. There's centralized exchanges. There's there's kind of, you can see everything's kind of
it's getting there. It's all moving in the right direction. I mean, after when this Tether situation came around, because Tether is viewed as being a much larger systemic risk, and it is, than something like Luna, Terra, the ecosystem. And there's even some concern that it could actually, if there was a big Tether blow up, it might actually be a systemic risk for the whole economy, right? Yeah. So I was getting a lot of calls from very large hedge fund managers and next day and all that kind of stuff that that I have relationships with, that have now grown to kind of trust mine and our firm's perspective in the space, and asking me what was happening and all that kind of stuff. And that's a lot better than the last time there was Tether FUD around, right, where I didn't get those calls, and I didn't get a single order at the end of those calls. But next time, maybe not next time after, we'll get an order, right? We're getting there.
Yeah.
And I think that the lack of, that there's a bunch of dynamics that I think are underappreciated, which I alluded to, but I for sure think the lack of partners in the space is something that is keeping institutions out. The easy way to make money in the space has been building some like retail focused platform that offers offers retail tools that they wouldn't usually have, like leverage, right? So and borrow lend. Like, retail investors don't get access to borrow lend, so you give them these kind of tools, and then you launch tokens around it and do all that kind of stuff. And that's what has really pushed. That's what's made a lot of the money in the space that has grown, has made companies overnight, right? So that's where people keep chasing. That's where, like, to use a Canadian sports analogy, that's where the puck is. It's not necessarily where the puck is going.
Yeah.
And I think that that this institutional way is the largest opportunity that the crypto ecosystem has to build a firm out. But there's been no focus on it. There's been like this, if you build it, they will come mentality to retail will come. And so these institutions who trade equities with 25 brokers, right? They're totally overbrokered in all their other asset classes. They have no one to speak to. I mean, I like to think that FRNT has become a firm that has is sought after in the space, but we're still a small firm, growing firm. We're building out our capacity and our team. We could use more help from the industry as a whole in supporting these investors, and versus in equities, people are complaining they don't want to pay brokers anymore because they've got way too many of them. And also, I've been trading equities for 50 years, broker, so why do I really need you? Yeah. In crypto, these firms are dying for people to explain them what's going on, and the infrastructure isn't being built, and the firms around this, and all the investment banks that are saying that they're building a crypto arms. Like, I mean, I have not seen I have not seen an announcement and then seen with my own eyes what that actually announcement manifests itself as and been impressed. Like, there's no focus. Like, there's these investment banks.
I mean, let me ask you this
Yeah.
then: what makes it hard for these traditional investment banks from going into crypto? Because obviously they've announced it, but the execution doesn't happen. And so why is that? Why can't they just set up, like, banks
Yeah.
have the FX department, commodities, rates, just add crypto and.
Well, there's some real frictions there already. Like, the Fed doesn't allow any Fed regulated bank to touch Bitcoin at all. So that's problem number one.
Okay.
But also, like Goldman Sachs did a transaction where they did kind of like a back-to-back options trade with Galaxy.
Yeah.
And 2 days later, one of their regulators came out and said, "Don't do that again," basically. So they have real things limiting them from participation in the ecosystem. But on top of that, I don't think that large firms are really well positioned to get into this space because for example, we were about to sign a deal that with a large asset management business in 2021 to the point where I was asked to make 2 separate press releases about this partnership. And it fell apart because at the last second, some, I don't even know, executive, board member, or whatever came in from the top and said, "No, you're not doing this without my approval," and it freaked all the other board members, executives out, and then the whole thing got put on ice. And there's so many people at all these organizations that are just ready to kill all of these different ideas, and they don't really want it to happen and all that. So basically what happens is you're sitting in, to paint the picture, that people are sitting in a boardroom and they go, okay, like, we don't want to look like dinosaurs here, but we can't go all in on this. We don't have the internal support.
Yeah.
There's 3 of our board members think the whole thing's going to zero. It's a Ponzi scheme. One of the board members' sons just got rug pulled in his own DeFi thing. Like, we can't do this. So that's kind of what you're seeing at organizations. And when the market's really rallying, maybe those people are kind of sitting back because they don't want to look like naysayers. But the second it turns, they're right there being like, "See, I told you we're not doing this," right? So there's constantly these false starts, as you saw with Goldman's first crypto desk. They completely shuttered, and the second the market started turning over in 2018, I don't know what's going to happen with this latest venture. But then they also, like, someone with a great crypto idea doesn't want to work with Goldman Sachs right now. They want to do their own thing, right? So they can't even support their clients to speak about this. So they're trying to go away from it. It's not to mention Goldman Sachs basically. And I'm using that. I'm sorry, I don't mean to beat up on you, Goldman Sachs. It's a positive that you're the name that comes to mind whenever I think of the financial industry. But like the Goldman Sachs and the BlackRocks of the world, okay? Bitcoin and cryptocurrency is essentially like a protest vote against like the old financial system, which these firms basically helped build and have profited off of a lot. So there's even cognitive dissonance amongst the executives that they're like, "What's so bad about what we make for everybody?" So they don't want to learn about it in the first place. And to get up the curve, David Solomon, Larry Fink would have to sit down with somebody like me, in their 30s. They don't want to do that. I don't blame them, right? There's guys, I wouldn't even feel comfortable talking to them about it, right? Because there's so much more experience than me in every other single way. So there's just all these these little blockers. There's large blockers, there's little blockers, and it's just like, there is definitely a certain amount of the industry that wants everyone to feel as though this institutional thing is happening right now because they already have huge valuations, and so they just got a whole bunch of investors to invest at large valuation X, and now they need to grow it above X. So how do I do that when I already have a huge percentage of the retail market share? I say the institutions are getting into, and that's my next leg of growth, right? So there's a lot of that happening.
Yeah. So your sense is that native or TradFi firms will find it hard to get into the crypto space. So it's better for new starters to come into it, and then also we're likely to see a pivot away from retail towards institutional, but it will take time.
Yeah, I don't know if it's a pivot away from retail, but more kind of like, I think that that right now the market cap around of companies that are retail focused versus institutionally focused is like over 90% retail, 10% institutional. Okay. Typically that's more like 50-50 versus capital market platforms and wealth management platforms, right? And I think that is going to become more more kind of
More
normal.
balanced,
There's people
yeah.
that want to do it on their own. There's people that want to hire experts to do it for themselves. There's already large pools of capital that are extremely sticky that aren't in the industry at all, right? So, yeah, I see that. I mean, we've got into one of our decks right now because we have a focus on OTC derivatives. We feel like we have the most sophisticated regulated structured products platform in the world. We're really trying to push that. And so, we compare the total open interest of the CME Bitcoin future, which is essentially the only real regulated product outside of like some of these trust products that has had serious uptake. And it's about 2 billion in open interest, versus Bitcoin at whatever it is, the latest $700 billion market cap. So you have 2 billion on a $700 billion asset. If you use a proxy like that in the interest rate environment, the OTC derivative and regulated OTC derivative marketplace alone the regulated OTC derivative marketplace is 4 times larger than the spot fixed income market, right?
Yeah.
So we've got less than 1% of the market cap of Bitcoin in regulated derivatives, which essentially is all that these other institutional people can buy. That's what it is. It's like, well, maybe there's something else that they can do, which would be the criticism to that.
Yeah.
Maybe they're doing something else. It's like they can't do anything else. If they could do anything, this would be what they could do. And
it's tiny.
And it's tiny.
Yeah.
So, I think that kind of regulated OTC derivatives, and this was literally what our thesis was in 2018. So now I read a Financial Times article that kind of says the same thing too. So it is all coming around. But that regulated OTC derivatives, a broader listed derivatives market, but I think OTC derivatives are going to be really important because the space moves so fast. It's a lot easier for a firm to send up an OTC derivative than and add more tools than the CME just like coming up with kind of multi-leg products that they've never really traded before, right? So I think that regulated OTC derivatives are going to be a huge source of growth. That's going to help firms get in the industry because it deals with a bunch of the frictions. They don't touch physical crypto.
Yeah.
It's just a derivative, right? A lot of firms have already having the risk disclosures that they can trade crypto derivatives. So I think I'm not sure what happens to this current cycle, but there's the next kind of adoption wave. I think might not be the ultimate adoption wave where the whole world of asset management has dedicated crypto strategies, but we can't be too many away. Maybe 3, 4, or 5 away. Yeah.
That's great. I mean, we've talked a lot about the crypto industry. I do like to ask some personal questions as well.
Yeah, absolutely.
So the first one I like to ask everyone is, what's the best investment advice you've ever got from anyone?
So my dad kind of gave me constant investment advice. So I just have to give him a shout out because he's definitely been the person that's taught me most about any industry, any elements of this industry. I was there's several kind of books that were really kind of foundational to my understanding of markets, but one of them for sure was Reminiscences of a Stock Operator.
Yeah.
And there's this scene with what the author refers to as Old Partridge, who's an old stock jockey, and he has this advice that is basically says that he doesn't buy stocks in bear markets and doesn't sell stocks in bull markets, right? And understanding underlying conditions is really half if not the whole battle, right? And I think that you can apply that. That's really kind of that's really how I've approached kind of every trade, like top down. Are we in an equity bull or bear market? Are we in a economic bull or bear market? Are we in equity bull or bear market? Are we in a financials bull or bear market? Are we in a large bank bull or bear market? And then you kind of get down to all of that. And if you've got everything lined up in a bull market, like you got a pretty good chance of success. And being a bull market is not being up 20% like it's become. Like it's the conditions of the typical trader. Like how is the market reacting? And people who've done this for a long time know that these markets react very differently. And if you don't know if you're in a bull or bear market and you're getting in, you're stacking the odds against you.
Yeah. And we mentioned earlier, you talked about Gen Z. I mean, what's your advice to youngsters? They say who are coming out of university into the job market. What advice would you give to them?
I don't really like giving so I generally kind of reject this online motivator person because I really couldn't take my experience and apply to somebody else. I had very specific things that applied to me, and for me to stand up at front of the stage and tell everyone how I managed my career, it's just completely ridiculous, I find. And it's
a sample size of one in your own history.
Exactly. And you don't know, like there's some people I would tell don't give up, and some people I tell give up. So like it's very hard. But I will say that one of the most common denominators that I have personally noticed with people that have really impressive success is that they got themselves in a position where they said to themselves that I think about esports as a great example. I mean, the people that are really successful over have been really successful in the esports industry and are sitting now with really large companies, like people like Nadeshot, who created 100 Thieves. This was like he's a great example. This 100 Thieves is one of the fastest growing esports organizations. The whole esports have a little bit of a dip now, but they've really created an impressive firm. This is a guy who liked playing video games, and so when he got into that industry, he said to himself, well, worst case scenario, I'll be in the video game industry, which makes me happy, and now all the economic success followed that. So I think that if you try to focus your energy on things that you really enjoy, and you can find a way to kind of create a life that that you like a life in an overhead, like don't get a huge apartment, a small apartment. So you go and be like, what, I'm pretty good doing this because I get to do what I love to do every day and get to do what I focus in. You usually win two ways, because the reason why you like it is probably some reasons why other people like it, and so you yourself are probably part of a trend that's just starting, and the likelihood that this becomes something that's more monetizable as time goes on is great. Plus, you're doing what you love to do in the first place. So, I think that's been overwhelming. Like the people who are successful in crypto now are people that many of these people would have just worked on this for very much not like the real builders in the ecosystem would have worked on this for much lower compensation, because they are like, I get to create a new financial system. How cool is that? What better use of my time can I think of? So I would focus on that. Like I would say that has been a real common denominator for the people that look like overnight successes now. Really, they just started doing something that they were really interested in, and the rest took care of itself.
Yeah. And you mentioned a book, Reminiscence of Stock Operator. Are there any other books that sort of influenced you?
For sure, and honestly, I think that reading is, like, if you're a young person, and reading is the most important thing you can do. Reading books is the most important thing you can do. As you get older, you have less time to sit down and read like a full book, and you got to keep up with so much stuff that's happening in real time. But being in university and high school is a great time to create like this foundation of your understanding that you can just incrementally build on as time goes along, particularly in markets. Reminiscence of Stock Operator, all the Market Wizards books by Jack Schwager. One book that just happened to be really important for me was a book called Hedge Hogging by Barton Biggs.
Oh yeah.
That I really enjoyed. I think that The Ascent of Money is also very foundational for understanding. I think that you really have to read about I think that there's many books about the financial crisis that you could read that would make that. I think it's very important to understand that kind of reset moment in the financial crisis to see where we've come from it. So like a book like Too Big to Fail is very entertaining and also really gives you the ins and outs of what happened there. And then the last thing that I would say is, I would read also entertaining finance books, like Michael Lewis books and all that kind of stuff, because I mean, some of those books really get you excited about the industry and stuff like that, and they really paint like a really nice, for me, reading like Liar's Poker and The Big Short and all that. It was just it just made you so excited, and so to be in that industry, and then you come to work every day. You come to work after reading a book like that. You're more excited than you can even imagine, right? So that's a pretty good subset. I think that'll keep your listeners busy for a little while.
Yeah. And what's the best way for people to follow you or to learn more about FRNT?
I would go to www.frnt.io and subscribe to our morning note. This is a product that we originally were using as a value add to clients. So remains, and we still write it as though it's an institutionally focused morning note. It comes out every weekday, and it has for 4+ years now. And I think it is that kind of more balanced, realistic, things are going bad, we say it. If things are going well, we say it. Look at the crypto industry that I think has been refreshing for a lot of our readers. So I think that's the best way to stay in touch with us. In terms of kind of news, we are on Twitter, we are on LinkedIn. I think LinkedIn has been a good source. We're frequently quoted in articles. We put out research. We repost a lot of that stuff on LinkedIn. That's a great way to, and that's just FRNT Financial on LinkedIn. We are on Twitter, but we're trying to grow that platform a little bit as well.
I'll include the links to everything you just mentioned as well. I have to say the newsletter is great. I mean, I read it every day. It's one of the best out there. So.
Yeah, well, it comes out under my name, but there's actually a team, Straw Savage and Joey Beatty, lead the team that puts that out there, but I get to take the credit for it every morning. So good work, guys.
Great. Well, with that, thanks a lot once again for taking the time to come out here and speak to us, and good luck with the company.
Thank you very much.
Great.
You as well.
Great. Thanks.